Good afternoon, everyone. Welcome to the Fusion Consulting webinar on using share ownership to incentivize your staff in a tax-efficient way. We'll get started in a moment or two. I can see we are getting more and more people joining as we speak. So I'll just give everyone a minute or two to join, and then we'll get started. I can see our numbers are still going up a little bit in terms of attendees, so we'll just give everyone just one more minute. I'm conscious of everyone's time, so I won't hold you all too long. Just going to give another minute to see if we get a few more attendees to make sure that people get in the room in time, and then we'll get started. Okay, great. I think we're ready to get started, and the numbers of attendees seem to all be in, so we'll get going. So once again, thank you for joining us today for our webinar on using share ownership to incentivize your staff in a tax-efficient way. We really appreciate your time in joining us in your busy week, and I'm sure this webinar will create lots of value for you and answer lots of questions in terms of how to implement share schemes and the different ones that are available for you. So once again, a little bit about us and who we are. Fusion Consulting is a 360 advisory service offering a range of different services to SMEs, entrepreneurs, and small businesses, in helping them grow and helping them overcome their barriers and reach their objectives. What we're here to talk about today is incentivizing key employees, and why that's more important than ever, and what the different options are and the different ways to do that. This webinar is really going to be valuable for business owners, entrepreneurs, and those in key positions in businesses who are trying to understand how they can grow their business, how they can incentivize their staff, and how they can do that in a tax-efficient way. There are loads of share scheme options available. The ones that we're going to talk about today are enterprise management incentive options, unapproved share options, growth shares, phantom options, and profit share schemes. And of course, one of the things that we're going to touch upon is how to implement the right scheme. It's really important that with so many options available to business owners out there, it's really important that you understand what the benefits are for each, what the drawbacks are, and what the different characteristics. And therefore, you can understand which is most suitable and most relevant to you as a business owner. And of course, most suitable for your staff as well. So one of the key reasons that people are implementing these schemes is to incentivize your team. It helps business owners attract and retain the best people for even longer periods of time. Employees understand that the equity that they hold by staying at the company is left on the table if they leave. And so they're holding the reward they keep until the end of their service with that company. And I think that's something that's more important than ever at the moment. The feedback that we're getting from the businesses that we work with and from the recruiters that we work with is that it's a real challenge for businesses to find the right staff and retain the right staff in the marketplace that we see today. And this is a really effective way to help businesses align their interests by giving management a sense of ownership in the company. In addition, it helps businesses, it's a good way of businesses giving something to the staff that doesn't cost the company money today. So for those businesses who want to offer something and reward staff and incentivize staff, but maybe the stage of the business that they're in, they might not have the capital to invest and to give out at that time. It's a really effective way to overcome that. And certainly it rewards those who help grow the business. And many business owners in this day and age are very keen on making sure that those people who have a key input and a key responsibility in growing their business are rewarded. Many businesses will see a benefit from a more committed and engaged workforce. Businesses with share schemes tend to outperform businesses that don't offer share schemes with employees. And of course, there are also tax breaks available as well. And that always helps to make the schemes more efficient and more effective for the business and the employees as well. So, one of the key things that we just touched upon, and one of the key things for most of you listening today, will be to understand which scheme is right for your business. There's many different schemes available. As I mentioned before, we're going to touch on a handful of them and go into them in a little bit more detail in terms of what they can do for your business, what the features and the characteristics are, and how they work. So, just moving on nicely, I'm going to hand over to Natasha, who is our legal executive here at Fusion Consulting in our legal department, and she will start giving the overview.
Thank you, Andrew. Okay, so we're going to begin with enterprise management investments. EMI schemes are a government-backed tax advantageous share option scheme. It is mainly used by small to mid-sized UK businesses looking to share their success with their team. An EMI option allows you to not only reward your employees with options and having tax advantages, but also offset both the costs of the scheme and the tax benefits achieved by your employees against your company's tax liability. EMI options can be operated by qualifying independent trading companies with assets of 30 million or less that have a permanent establishment in the UK. They are highly flexible and tax-efficient schemes which are designed specifically for small or medium businesses and can be drafted to meet the company's individual needs and objectives. They are granted for commercial reasons in order to recruit or retain employees in a company and can be immensely powerful tools to incentivize employees up to the value of £250,000. EMI options should not be granted as part of a scheme or arrangement with the main purpose being to avoid tax. EMI options can be granted under scheme rules or by using a standalone EMI option agreement. EMI options are generally granted in exit-only schemes, whereby the option will be exercised by the option holder, the employee, upon such an occurrence happening, such as a takeover. They can, however, be granted in terms of a standalone agreement, in which case the option holder must exercise their rights before 10 years has passed. The company offers a class of employees the option to buy a set number of shares at a fixed price, which is an option agreement. This fixed price can either be the market value of the shares at the time, in which case no income tax or national insurance contributions, NICs, are payable, or the fixed price can be granted at a discounted rate to the market value at the time, in which case income tax and NICs are payable by both the employer and the employee. Tax relief is given to the company in the accounting year in which the options are exercised and should be claimed by the option holder's employing company. Assuming that the company itself is the grantor, there is no capital gains tax payable for either the company or the employee. There is no minimum period before which the EMI option may be exercised in order for the employees to benefit from the preferential income tax and NIC treatment. However, if the employee makes a profit from the sale of the exercised shares, they will be liable for capital gains tax. Once the option is exercised, the option holder is entitled to all the same rights as other shareholders. In order to qualify, the employee must meet the statutory time requirement, which is the committed time. An employee must work at least 25 hours or 75% of their working time must be committed to the company in order for them to qualify. It is a key requirement that at least 2 years must have been passed from the date of grant to the subsequent disposal of the option by the employee. In the event of an option holder dying, the option must be exercised within the period of 1 year following the option holder's death. There is flexibility in relation to the leaver provisions which can be imposed, and it can be drafted to have the effect that the option will lapse automatically on termination, or the option leaver can retain their option should they leave after a specified period of time. We're going to move on to unapproved share options. Unapproved share options historically were seen as tax inefficient, but tax inefficiencies can be limited by the way the unapproved share option scheme is structured. It's often exit-based, meaning that they incentivize employees to work towards an exit by providing share options that are only exercised on an exit. As with approved options, there's no initial tax cost up front. Any gain on exercise will be taxed as employment income. Unapproved shares is the term used to refer to any share option which is not granted under any statutory tax advantage option scheme, such as company share option plans, CSOPs, enterprise management incentive schemes, EMIs, and save as you earn schemes, SAY. And is a term used to refer to any share option that does not benefit from HMRC tax advantageous treatment. This type of share gives employees the right to acquire shares once certain conditions have been met and provided they pay a specified amount. It's the most widely used form of employee share incentives. It offers flexibility for a company as the options can be designed to meet the employer's own commercial objectives. These shares are granted to the employees by means of a standalone deed between the company and the employee, or through the use of a governing set of unapproved share option plan rules and an accompanying short form agreement. The latter agreement is typically used where the grant of an option is to a number of employees at the same time. Unapproved share options can be granted by existing shareholders in respect of their own shares. Unapproved share options are not granted under any of the statutory tax advantage schemes, and originates from when tax advantage schemes normally had to be formally approved by the HMRC, which is no longer the case. There is a specific exemption from any liability to income tax in respect of the acquisition of unapproved employment-related securities, and as such, no income tax is charged. The charge of residual benefits upon the acquisition of these shares. Any income tax related to unapproved shares is deferred until the subsequent chargeable event. Upon exercise of the unapproved shares or the chargeable event, the relevant employee or director may be subject to income tax and possible NICs, and the employing company may have PAYE and NICs obligations arise. The postponement of any income tax charge from the date of acquisition until the chargeable event is not, however, necessarily beneficial. If the shares increase in value by the time the chargeable event occurs, the employee or director will end up paying more tax under the securities option rule than they otherwise would. Depending on the structure of the arrangement, there could potentially be a charge to income tax on the money's worth value of the option at grant, followed by a tax charge on the exercise of the option. The taxable amount is treated as employment income of the employee or director for the tax year which the chargeable event occurs. We're going to move on to growth shares. Growth shares, if structured correctly, are a cost-effective and tax-efficient way to provide key members of the management team with the access to shares while incentivizing them to grow the value of the business for their own personal benefit. It offers significant tax savings to both the employee and the employer. When the growth shares are acquired, their full unrestricted market value should be relatively low, reflecting the fact that they have a high hope value. The tax cost to employees of acquiring their growth shares is therefore made more affordable, and the downside risk to employees is reduced. It's a commercially flexible scheme and therefore can be made fortifiable on employees leaving. These rights are designed to allow employees only to participate in post-acquisition increases in the value of the company. These shares therefore tend to have a similar economic effect to an option with a market value exercise price. The key elements of growth shares are that the employee subscribes for the growth shares at the outset. This differs from a share option or conditional share award, as these are structured so that the employee only receives the shares on a future date once certain conditions have been met. The benefit of structuring the growth shares in this way is that any growth in the value of the company after the employee has subscribed for the growth shares should be subject to capital gains tax treatment, as opposed to being within the income tax and NIC's regime. Therefore, growth shares can be very tax efficient incentives for both the employee and the employer. They can also be attractive to employees, although they are paying to acquire the shares at the outset. They involve less financial risk for the employee compared to an acquisition of ordinary shares. Growth shares can be attractive to existing ordinary shareholders, as their interest in the growth in the value of the company that has been achieved prior to the grant of the shares may not be diluted to the same extent as if the share incentive is structured over ordinary shares. Growth shares are a useful way of delivering tax-efficient share awards, particularly where the relevant company is unable to qualify to operate tax-advantaged plans. The value that participants are intended to receive under the incentive is greater than the statutory limits. It's a flexible structure which can apply to parent companies or subsidiaries, and unlike tax-advantaged schemes, they can enable employees to participate in the growth of the employing subsidiary company only. Employees continue to be incentivized by reference to the progress of its specific business rather than the progress of the wider group. Growth shares involve the introduction of a new class of shares, and as such tend not to be suitable for listed companies. However, there are some listed companies operating growth shares as a joint share plan, which allows the company to achieve a similar commercial result without the need to change the company's share capital structure. Growth shares are specifically constituted and classified under the Articles of Association. They will be offered to selected employees and will be subject to the provisions of the Articles of Association. Growth shares should be structured to have their rights set out in the Articles of Association to minimize the risk of income tax charge. A key consideration with growth shares is that although they are designed to offer a tax-efficient incentive, they are not a tax-advantaged scheme that is governed by statute, and therefore their tax treatment may be subject to challenge by the HMRC in the future. The HMRC no longer offers a top-up amount that determines the unrestricted market value, and as a result, companies and their growth shareholders have some ongoing uncertainty regarding whether there is outstanding income tax or NICs due. Growth share structures have become more subject to risk as a result of this, and if income tax is due in respect of the acquisition of growth shares, NICs will be payable as well as PAYE. On a share sale of the company where the growth shareholder receives no more than the market value for the shares, the gain that the growth shareholder makes when the shareholder disposes of their shares will be subject to capital gains tax. Growth shares can be costly to implement due to the potentially substantial legal fees involved in redrafting the Articles of Association in order to include all provisions relevant to the growth shares, and the cost of obtaining a specialist valuation each time there's a subscription for value shares. Growth shares are a complex structure and therefore less straightforward for employees to understand, and thus they are typically offered to key executives only. Growth shares are sometimes granted under EMI options. A key advantage to do this is that the HMRC will not normally agree the value for tax purposes before share subscription, but they will do so if the shares will be subject to an EMI option grant. Next up, we've got phantom shares. Phantom shares allow the employer to achieve some of the benefits of employee share options without actually giving any shares. In essence, it's a cash bonus. Typically, each employee is granted a number of notional share options such that bonuses are calculated by reference to the notional gain on the shares. The phantom share option plan is linked to the performance of the company, as bonuses will be linked to any increase in the value of the company. Unlike share options, phantom options and awards do not entitle the holder to acquire shares. Phantom options are a right to receive a cash amount which reflects the increase in the value of the company shares over a specified period above a notional exercise price value. A phantom share has the same economic effect as an unapproved share when it is exercised, except that the employee is not required to pay any exercise price and will receive cash rather than shares. They are often used by a company where it wishes to incentivize its employees by reference to share value, but is unable to grant them such rights to acquire real shares. Phantom shares have a less dilutive effect for shareholders than a share option, in that if a phantom option or award is granted, it involves no dilution whatsoever for the shareholders. No shares are actually issued or transferred to the option holder on the exercise of the phantom share option, and therefore awards are fully taxable. These plans are often used by companies who are restricted from issuing actual shares to their employees. Profit share schemes. Profit share schemes reward and incentivize management to achieve higher profits by awarding them a percentage of the company's profit. Whilst this might not be the most tax-efficient way to reward your management, it is a viable alternative if you are not prepared to offer shares. Profit shares is a type of employee compensation. Companies calculate their profits over the financial year, and then they give a percentage of the money to their employees. The profit sharing can be paid directly to the employee each quarter, annually, or as a lump sum at retirement. Profit shares, in some instances, are paid as shares in the company rather than as a cash bonus. The main types of profit shares are pro rata, where everyone receives a share of the profits that is calculated based on their salary; non-comparable. This type of profit share scheme might offer different rates of profit share to different groups of employees, such as full-time employees will get a higher rate than part-time employees. Age-weighted. The age and salary are considered when calculating profit shares. An age-weighted profit sharing scheme will allocate a higher percentage of shared contributions to older employees. This type of profit share is based on the logic that older employees have less time to save. The benefits of profit shares are that your employees tend to be more loyal, efficient, productive, and this leads to more profit. Profit share schemes are costly and complex to set up. Capital gains tax might be payable if a profit is made when the employee sells their shares or other investments.
Thanks, Natasha. I think, as you can all see, there's a lot of complexity and intricacies to each scheme, and it's really, really important. And the challenge is understanding which scheme works best for your business and which scheme suits your objectives and which scheme suits the vision of your company. So it's really important to make sure that professional advice is taken where necessary to make sure that the right scheme is selected, chosen, and implemented. And often that will include advice from a tax, accounting, and a legal perspective. So in most cases, at the very least, you're going to require legal documentation for the share options, shareholders agreements, option agreements and such. You're going to require share allotments, share certificates, board minutes, company secretarial, and of course, the option documentation as well. So there's a huge wealth of documentation and advice and implementation that really comes into play. And there's even more that needs to be looked at as well from a business perspective. Often we focus on making companies aware of a number of points. Firstly, you really have to understand the value of your company, because the shares will have to be valued when they're granted. So getting that right in the first instance is really important. And also ensuring what restrictions are in place are put together in a proper and effective manner based on your clear objectives and outcomes. Because making sure that, for example, some businesses want to make sure that management don't get shares until they've been in the company for a period of time, or if they leave, that they can get bought out, or there's a proper process in place to make sure that when people leave, their shares or their options are dealt with in the manner that is intended from the outset. And that requires a lot of thought. So it's important that these things are gone through in a detailed perspective, because you want to make sure that the processes and the restrictions in place reflect the company culture and what the outcomes that the business owners and the employees want to get from it. It's also important to understand for the employees the implication of the exit plan. It's to make sure that they can be aligned, that they know what they're going to get out of it, that they know what their reward is going to be for all the hard work that they're putting in. And of course, if the overall objective, or if one of the overall objectives, is to make sure that employees are motivated, aligned, and incentivized, then ensuring that they have clarity on the exit plan and how and when their reward will look like is really important as well. So if we look at how to implement the various share schemes that we've been discussing, choosing the right scheme has very much got to match your business model, your vision, and your long-term objectives. And of course, how you want to reward your employees and which employees you want to reward. So you really need to discuss with your team, make sure that employees understand what the implications are for them, what the tax implications are as well, because that's going to be a big factor in terms of how well rewarded they are. And they'll also need to know the conditions and the restrictions. It's important that they can see, when they have their hard work and their contribution to the company, how that is going to affect them and how they're going to what their outcome is for those employees. You've then got to engage with your accountant. In some cases, you may need to value your company for granting the shares, or especially if you're going for an HMRC scheme, you'll certainly need to value the company. So having those company valuations and discussing with your accounting team at that point in time is really important, and then going ahead and actually applying for those schemes. Again, as we touched upon previously, it's really important to engage with your legal team or your lawyers as well to make sure that you draft the agreements and make sure that these are done correctly, to make sure that you're protected and that every single restriction and covenant that you want to have in place from the outset is clearly and correctly done to make sure that your risk is managed in the best way possible. All in all, I think the implementation process can take anywhere between 12 and 18 weeks. And that's going all the way from selecting the scheme that's suitable for you, agreeing conditions, company valuation, applying for schemes, and then getting legal documentation and agreements drafted. And it can be quite a challenging and intensive process for businesses to do that, for them to liaise with each different professional partner in silo. And one of the things that we can do to help, if I move on to the next slide, is one of the things that we can do to help is, and one of the ways that we can add real value to companies going through this process, is that we can take care of the whole process for you. From consulting with you on choosing the right scheme to implement, which is, I think, a really important stage, especially with the complexity and the detail involved in each schemes. Helping you to present to your staff, of course. Our accounting team can take care of the company valuation and the scheme application. And if there's any liaising that needs to be done with HMRC, then our accounting team is well placed to take care of all of that. And our legal team can take care of the agreements for you. They'll take care to make sure that you're protected and to make sure that all of the different documentation, agreements and contracts are done in the absolute correct way to make sure that you are covered. So we can manage it from a full end-to-end perspective to make sure that you're taken care of and that everything is implemented as you intended. It's a useful, I guess, step into talking about Fusion. For those of you who haven't come across Fusion before or don't know too much about us, we're an award-winning global consultancy who provide a 360 advisory service for private clients, entrepreneurs, and business owners. Our expert advice spans a number of different divisions to make sure that we can provide all of those different types of clients with all of the support, advice, and help they need to achieve their objectives. We've got a legal division that take care of corporate and commercial work, including mergers and acquisitions, take care of corporate structures to shareholder agreements, articles, contracts, and share schemes. And the aim really is to protect you and your business, maximize your upside, and minimize your risk. We've got a proactive and dynamic accountancy division who are more than just filing returns. It's very much focused on helping business owners understand their numbers, understand their business, seeking opportunities to see how they can grow and how they can really achieve what they want to achieve from business perspective. It's about much more than just filing returns. It's really about helping business owners achieve the potential that they have in their business. We also have a tax team, which is very much focused on ensuring that our private clients and our business owners are as tax efficient as possible, making sure that they understand tax implications of all of their activities, and making sure that they have the different options available to them and how they can be as effective as possible in that space. We also have a financial advisory team, which is very much focused on helping clients build their wealth, helping them protect their wealth and their families, and also making sure that any businesses, if they need to have capital invested in the right way to help to make the most of any capital within the business, they can also work on that side with business owners as well as private clients. Finally, we also have a recruitment team which focuses on helping businesses grow by identifying and achieving and bringing on the right staff and the right employees that are focused on working together with the business moving forward. We understand that it's really important for all businesses to have the right support, and we aim to offer that all in-house to make sure that you have it delivered as seamlessly and as easily as possible. So you can focus, also business owners can focus on building and growing their business rather than all of these different aspects that need to be taken care of. As we've discussed, it's a really complex area that we've touched upon here. We've gone into quite a lot of detail because we want to make sure that you understand some of the different options available to you and the different features and benefits of those options, because it's important to know all of the detail of the different options so you can understand how they apply to you, how they apply to your business, and how they apply to your employees. And when done correctly, they can be a fantastic tool to help your business grow. And that's why it's so important to choose the right scheme and implement the right scheme effectively. As I mentioned previously, we have a wealth of expertise in-house across a range of different divisions and services to really ensure that we can deliver the service for you to make sure that you can put the right schemes in place and help your business grow. If you'd like to have a free consultation with any of our experts on this topic or any other, then please do get in touch with us. You're very welcome to email on andrew@fusionconsult.co.uk, and you have mine and Natasha's contact details there. So really, please do get in touch if you'd like to learn more. If you'd like to have a brief chat about how we can help, we're always available to have those conversations with you and help you move your business forward. Thank you all once again for your time. It's very much appreciated. We appreciate you taking time out of your day. I'm Andrew Sheener. I'm the head of sales and marketing here at Fusion Consulting. And we've also had Natasha on the call as well, who's given you the overview of the different schemes available. And she's our legal executive. Thank you once again. Please do get in touch and we look forward to hearing from you.
Thank you.